Welcome to the What to Watch video update. This is a video that I do last over the weekend where I pick out the charts, positive and negative, of things that I'm really watching right now and really honing in on. Now, this can change from day to day. This is just how things look as of the end of the weekend. Then I have a third section where I look at things that are not necessarily positive or negative, but I'm just keeping an eye on because that can have an impact on the stock market. This week we're asking the question, will the S&P 500 decline continue? And it's being prepared for Monday, March 3rd. The first area that we'll look at are those things that are considered to be positive. When we look at the S&P 500 and the advanced decline line, the things that are going up versus the things that are going down, this is holding up fairly well right now. It did bounce up a little bit on Friday based on price and volume after it had been going sideways with price and actually declining based on volume. So under the surface, the S&P 500 is hanging in there. Now what we're seeing is a rotation. And that's what we're trying to figure out. Is this rotation going to continue going from being on offense to more defense? That's what we've been seeing. When the market is more offensive, that's when we're really going up. When the market's defensive, that's when we're getting ready to go down. And that's the tug of war that's going on currently. So in the meantime, it's not like money's coming out of the S&P 500 so much. It's just that it's going from one area to another. And so that's keeping our advanced decline lines holding up for right now. We're still above these advancing moving averages. Also, inside of the S&P, we have the advancers and decliners over a 10-day period. Even with the declines that we've been seeing, this oscillator has actually been holding up quite well. It's above zero and is actually positive. We also look internally in the S&P at the new highs minus the new lows. We see a lot more green than red, and our 5 days going up, rolling over a little bit. And our 10-day had been going up and it's starting to level off. But for the most part, this is still holding up considering what has been happening with the S&P. This is smart money indicator number one, and this one is still looking more positive. I have three smart money indicators that I look at. This one is positive, the other two are actually negative, but seeing some improvement. This uses not only price but volume in how it's calculated. And when this is going up, that's more positive. And when we're above this red line, which is a moving average, that's positive as well. Well, we started to get kind of far away from the moving average. We were declining, so the context was that this was turning more negative. We came right down to the moving average after Thursday, and this was actually looking to go below the red line. That would turn it full-blown negative. Well, we bounced up in Friday's session, so this is looking a little more positive. I have another indicator down here at the bottom that I call the boom indicator. It's really not helping us right now. It's supposed to measure the distance from the indicator to the moving average, and it's really been getting things wrong lately. It's really just a modified MACD that sometimes is helpful, and right now it hasn't been all that helpful. Even with the declines that we've seen, the advanced decline ratio in the short term, 19 periods, and intermediate term, 39 periods, have been holding out for the most part above the zero line. So that's been hanging in there. And when I look at the advanced decline line studies, some of them are looking more negative, some are positive, but it's the S&P 500 that I really hone in on the most, and that's why this is positive. Even with the declines that we were seeing, we're still going sideways here above the moving average. Now we saw a little bit of weakness with the NYSE common stock, but it came back up to its moving average on Friday. The mid caps are coming back up to their moving average. A little bit of a bounce here with the small cap, but still below its moving average. And when we look at the McClellan Oscillator for just the S&P, we did cross back above zero. So that's showing some more strength coming into the S&P 500. And even when we were declining, we weren't seeing this really going down with any real velocity. So we're seeing a mixed picture here. If you pick it out based on price, because we're above zero with the McClellan Oscillator, we're turning back up a little bit here based on price. However, this is mixed because we're still going down based on volume. So I could have easily put this on the negative side. We Are seeing an improvement with the swelling trading oscillator. After Friday, we're turning back up based on price and volume, and we're actually crossing back above zero with price. We're improving here based on volume. And this is a weekly chart of the parabolic SAR. Even after the declines that we saw this past week, there wasn't enough of a decline to put the dots on top. When the dots are underneath, that's positive. When the dots are on top, that would be negative. So longer term, this is still looking more positive. Then we look at those stocks inside the S&P that are above their 20 period moving averages. We crossed back above 50. This is the line between positive and negative. So short term, we've been holding up fairly well, not showing a lot of strength, but this is improving. Now longer term, when we were tending to go up with the S&P, we were seeing this indicator actually going down, and that's a negative divergence, and that could be longer term negative. What I'm honing in on right now is just the short term, day to day action for right now. And this is looking a little more positive. We also crossed back above 50 and showing some improvement with our 50 period moving average study, 100 period moving average study, and we never crossed below 50 with the 200 period moving average study. And there's not an awful lot of strength going on right now, but it did bounce back up and it's been holding up as we've been going down. Then this is a little more positive than it looks. This is a ratio between large caps and small caps. And it's not that the large caps have been doing so well to give us this upward thrust. It's that small caps have been kind of falling apart. And so when you do a ratio between the two, the large caps are still holding up better than the small caps. And then longer term, this is a weekly chart of the S&P 500 going back to the 1987 crash. We're still well above this long-term trend line. Financial sector's been looking pretty good and had a good day on Friday. It's not quite at a new all-time high here, but it's in a solid uptrend and it's above its 50 period moving average. And we like it when the financial sector is strong. That helps the rest of the market. And we look at a ratio between the NASDAQ 100, represented here by the Qs, and the small caps. We're above this blue line. So that's positive. If you look way back to the year 2000, we came up and set a high level and then just tanked after that. This is the dot-com bust. Well, it looked like we were going to kind of come up to this level again and then turn and go down. That's what the perma bears thought. But we continue to go up with this ratio. And then a weekly chart of the NASDAQ 100, even though we came down a little bit below this long-term trend line, we're still dealing with that. We haven't really fallen underneath that with any real conviction, at least yet. And we look at another ratio, but between the NASDAQ 100, which is growth, and the Dow, which is considered to be value. And this is continuing to go up above this red line. So that's holding up. And we have been coming down with interest rates. The 10-year yield is actually dropping down to its 200-day moving average. We're just a little bit below that right now. Now, a week ago and 2 weeks ago when I did this video, the stock market was really keying off of interest rates. Over the last week, we've seen a shift away from that, where folks are taking their money out of the stock market. That makes prices go down. And they're buying bonds, which makes prices go up. And that's when prices go up, interest rates go down. And that's why we've been seeing this actually dropping lower. Now we look at the negative side, and unfortunately, it's quite a bit longer. Since we had a down week, here's an intraday chart where earlier in the week it looked like, okay, things were starting off pretty good, but then we saw some late day weakness. Now, what we saw on Tuesday was actually positive, even though we had a down day. We saw early weakness because that's the amateurs who open the market. And then we hit a base here, and then we saw some buying going into the close. And that's pretty good. And we want to see late day buying. So it looked like, okay, maybe things are holding up for right now. But then we saw just the reverse of that on Wednesday. Early strength, late day weakness. Then Thursday, this is when things really started to shift. We had a positive open and we gyrated around for quite a while. And then the smart money came in later and just decided to take us lower. This is when things really turned a lot more negative. Then on Friday, it was just kind of the opposite, where we saw a bit of a nice bounce at the open and then we fell back. Now, this area that built up as a base was right around the 200 period moving average for the NASDAQ. That is a support level that held. That's why I look at a lot of different charts. Everything I do is based around the S&P 500, but I look at the Dow, I look at the Nasdaq 100, I look at other sectors because all of that is interrelated to each other. And that's why my videos are longer. That's why I show more charts. I don't believe in this analysis paralysis foolishness. We want to take in as much information as we can and then using a big picture, whittle it down and say, okay, what is our current evaluation of the S&P 500? So we hit that base area and then saw some really nice buying going into the close. Now, are we going to bounce off of that 200-day moving average and keep going on the Nasdaq? We don't know yet, but it was a good start in Friday's session. Then, as far as sentiment, people are quite negative right now in the market. When we drop below 25, that means folks are very pessimistic about the market. We bounced up a little bit in Friday's session, but we're still getting a negative reading. Now, this could be treated as negative because we're getting such a low reading. But it could also be treated as positive because usually when we get to a really low reading like this, that means there's kind of a washout that has happened. And we use this as a contrarian indicator, meaning that, okay, maybe folks are so pessimistic, they're so convinced the market's going to go down that all the selling has completed and now we could look at start going back up. We don't know that yet. That's why this is on the negative side because for the most part, the sentiment is still negative. And even though we're below 25, this still could go lower than where we're at right now. Another thing that's negative on the surface are the American Association of Individual Investors. Every week they put out a survey. How are you feeling? Are you bullish? Are you bearish? Well, they came in with a really, really negative reading. Now that's negative, but on the positive side, it's an extreme negative reading. And we can also look at using this as a contrarian indicator that maybe we'll get a bit of a bounce out of this because everybody is so pessimistic. It's like, okay, they've already sold, there's nobody left to sell, so maybe there'll be some buying that comes in. And with the VIX, we're getting very high readings. Now, after Thursday, we were above 20, and that's when things turn quite negative with the VIX. That's when fear is really picking up, and we see negative annualized returns. We saw enough of a bounce on Friday to bring us back down under 20. And the line chart that you see here is the closing value for the VIX, and then I have the bar chart here. We spent some of the day on Friday above 20, but ultimately we came back down. So this is negative because we're getting such a high reading, but it is showing some improvements. The momentum for the VIX continues to be up. And when the VIX is going up, that means stocks are going down. And then we look at the risk on versus risk off ratio. This is really coming down right now. We've been chopping around for most of 2025, not really showing much conviction, and we still could go back into a choppy environment. But to see this really drop off, that means that folks are getting out of the riskier stocks that are nice when they're going up and getting into more conservative stocks, which tend to hold up better when we're going down. And when we see this ratio going down, that just means they're getting more risk off currently. Intraday, looking at growth of value, we had been positive with the blue line above the red line. Well, now we saw the blue line dropping below the red line, even though it improved a bit on Friday. But the fact that the blue line is below the red line is more negative, even though these two different measurements are on different scales. And then we look at an intraday chart of growth to value for the S&P. It had been doing quite well and looking pretty solid as we were working our way through February. Then about halfway through February, boom, we just started to go down, even though there was a bit of a bounce on Friday. Then we look at an end of day chart. Small caps are just really going the opposite direction that a lot of people had hoped they would. They're going down. And we're still positive with our growth to value ratio for the small caps, but we've dropped below the 200-day moving average with this ratio. Also, mid caps not doing all that well these days, dropping below their 50-day moving average here with this ratio, and seeing some hits here below the 50-day moving average with S&P growth to value, even though it's still in a longer-term uptrend. To turn more positive, we want to see this ratio going back up, not continue to go down. And this is a growth versus value ratio here with a growth ETF versus a value ETF. Now we're coming all the way down to the 250 period moving average with this ratio. And we saw a little bit of a tick up on Friday. We've seen this before, and then we were able to bounce up out of that. Now, we don't know if this is going to happen or not. So if we do bounce up out of that, that's going to be more positive. If we break further below the rainbow, that's naturally going to turn things more negative. And looking at other growth to value ratios here, the Qs to S&P are going down, discretionary to the S&P going down, and large cap growth is underperforming large cap value. We're going down with the large caps, mid caps, and small caps. So not seeing any real strength there, at least yet. Discretionary to staples also going down below its 50-day moving average when we do a ratio. And it's not so much that discretionary is falling apart. This is an equal weight version of discretionary. If you look at the discretionary sector by itself, it's really been declining because most of that is Tesla. Well, if you look at an equal weight version of the discretionary sector, which is what this is, this has been holding up a little bit better. What's making this ratio go down is that staples have been going up. Discretionary is more offensive or growth oriented, or staples, that's more defensive. That's what the market gets into because it tends to hold up better if we're actually declining. So that's why I've been really watching the interplay between growth versus value, discretionary versus staples lately. And we're negative overall when we look at the broad market and take a 5 period moving average of the highs and lows. We're below zero and declining currently. Large cap growth seeing some hits here, not all the way down to their 200-day moving average, but we did drop below the 50 and the 100. So you can see that there's some weakness coming in here. Now, we didn't quite get down to the 200-day moving average. This was the end of the world day last summer in August, and we were able to bounce up out of that. Is something like that going to be able to happen, or are we going to continue to go down to the 200-day moving average? Now, looking at the trend, we're negative. This is an intermediate term trend chart here, where the red line, even though it came down on Friday, is above the green line, which continues to decline. We're finally trending after spending a long time underneath the moving average. This goes all the way back into January, where we're turning back up at the ADX. That means the trend is starting to get stronger and it's above the moving average. Now, it's not officially a trend until we get back above 20, but I don't like to just use that static number. That's why I put a moving average on this indicator to give us a little bit more context. But this is a strengthening negative trend for right now. That's not officially a trend. Short term, we are starting to see a trend here. We're crossing above 20. We're above the moving average. The red line's on top, the green line's on bottom. So this is a short term negative trend. And then this is a weekly chart where we're still not trending here. We're possibly bottoming out with the ADX. But just this past week, the green line was above the red line. Now the red line's above the green line. So even long term, based on this chart, we're not trending, but what is happening is negative. And then we look at the condition of the short-term trend. We're below both lines and the lines are going down. That just shows more weakness. This is a 20-period simple and exponential moving average, also below both of these moving averages, and the lines are going down themselves. The intermediate term trend below both lines and declining. The simple and exponential moving averages were below the 50 here. And now the 100 came into play. Now it was initially looking pretty good with the 100 period moving average holding up, but then we had that big down day on Thursday and we broke below the 100 period moving average and closed. That's different than what we saw earlier in January. We had 3 days here where we went below the 100-day moving average, but we closed above the 100-day moving average, and then we came up out of that. So it looked like, okay, maybe we're going to continue to go down here. Well, now we're coming back up, but what was once support has now become resistance. We came right back up to the 100 period simple moving average, and that's where we closed in Friday's session. Looking at all the moving averages together, we're below the 20 and 50 and right at the 100 period moving averages. And this is a longer term look, a rainbow going from 10 periods up to 50 periods, where we're below all the lines in the rainbow. The longer we stay below this, the more these lines will roll over. And this is just showing weakness in the short term. We're also below the rainbow in the intermediate term. The lines are crunching up, getting closer to each other, but they haven't quite started to roll over yet. Long term, we're still going up with the lines, but we're coming down deeper into the rainbow. And this goes from 50 periods up to 250 periods. These are anchored moving averages, which try to project forward here. And I just have some anchored moving averages going from previous lows here. And we broke through this red line, which is shorter term, came through this purple line, but we're holding up right here with this low that was set last August. And maybe this is a level that will hold because we came about down to here and then we've been bouncing up off of that. Now, this is smart money indicator number two, the Chaikin money flow. And even though it's green, it's going down and the red line's going down. That's why this is negative. And then here's smart money indicator number three. It's below the midpoint. Even though it bounced back up on Friday, it hasn't crossed back above a moving average that I have plotted on here. So this is still treated as negative until we cross back above the moving average. This is the vortex, another primary indicator that I use, pretty easy to interpret. Red's on top, green's on bottom. That means we're negative, and the red line's going up. The green line did bounce up a little bit, but overall it's been declining. And this is a daily chart of the parabolic SCR. We're still positive on the weekly side, longer term, but we're negative here with the dots on top on the daily side. Momentum is negative across the board. I have two short-term oscillators, three intermediate-term oscillators, and two long-term oscillators. They're all going down below their moving averages. This is negative. Another momentum oscillator that's negative is the Copic curve. And we came down, we saw some O's drawn in this past week. This is after Friday, the new red O that's in here. And we're seeing a double bottom breakdown. Here's what the point and figure chart is coming up with. And of course, that is more negative. And then this is negative and positive kind of at the same time. This is the Ichimoku cloud. It's negative that we fell down below the cloud on Thursday, but it's positive that we came back up on Friday. The blue line and the red line are pretty much on top of each other. That's more neutral, but they are both declining, so you could lean more negative. Then there's a green line in here that's kind of hard to see. That's more short term, and that is negative. And then I'm chalking this up as being negative, which you'd think it'd be positive. This is a trend channel going back to 2009. And we actually went above that in 2021, only to go into 2022, which was a cyclical bear market. Well, we hit this in December and we have not been able to really get above this. We set some new highs week before last, but not an awful lot of conviction. And as we get up closer to this upper line, this is where we're seeing a real slowdown in momentum. So that's why I'm treating it as negative. And we look at the NYSE McClellan Oscillator. Now, the S&P McClellan Oscillator, that's positive. It's above zero. But here, even though we're improving with the broader market, and the NYSE is holding up fairly well, but we're still below zero with the McClellan Oscillator. And when we're negative with the McClellan Oscillator, we're going down based on price and volume with the summation index. So that's negative there. And the bullish percent index. This measures the point and figure buyer sell signals inside the S&P. We're declining and below 50. That's negative. The NYSE bullish percent index also below 50 and declining. That's negative. And the NASDAQ 100 bullish percent index is also below 50 and declining. So that's another negative sign there. The Wilshire 5000 is a broad market measure. We're in a longer term uptrend, but we fell down below the 50 period moving average. And then the total US stock ETF, another broad market measure. This is still in a longer term uptrend, but falling below the 50-day moving average. The Dow's really having a difficult time. It's actually holding up the best right now. It's not that it's going up, it's going down less than some of the other indexes. We're still battling around the 50-day moving average and hitting some overhead resistance here at this pivot point. This is what I keyed off of on Friday. That and then the anchored moving averages for the S&P 500. We came down and hit the 200-day moving average for the Nasdaq, and that was about the time we bottomed in the S&P and then started to go up off of this. Is this the beginning of something? It could be. We came down about to this level before and then saw a nice little bounce up out of that. But if we don't continue to go up, if we just kind of hang around here or even drop below the 200-day moving average, that's going to be negative. And that's why this chart is negative. It's improving, but it's still treated as negative until proven otherwise, even though it's still in a longer term uptrend. NASDAQ 100 still has a ways to go. If we see more weakness, we'll be watching the 200-day moving average here, still in a longer term uptrend, but seeing some weakness. The momentum for the NASDAQ 100 is negative as measured by the PPO, which is a momentum oscillator. Small caps just really having a hard time. Broke below their 200-day moving average here with the S&P 600, below the 200-day moving average with the Russell 2000 small caps. We're looking kind of extreme here, negative with the RSI, but the momentum is negative and we're well below the 200-day moving average. Mid caps also battling around below their 200-day moving average, even though they're still in a longer term uptrend. The FANG index, these are really big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia, below its 50-day moving average, which is why in the more short term it's negative. And then we look at a ratio of stocks to bonds. And when this is going up the way it has been for the most part, that means the market is anticipating a soft landing, which means we won't go into a recession. Well, lately that's been in doubt. And we're coming back down into the rainbow. Now, if we bounce up out of this, because we've been down into this rainbow before and recovered, that would be positive. But if we keep going down and then we drop below the rainbow and then the lines start to roll over, that's going to mean the market is anticipating that we're going to go into a recession. And then this is an inverse of that same chart, just showing bonds first and how, for the most part, they've been underperforming stocks, but lately bouncing back up here. We'll see. Is this going to continue to go up or are we going to turn and go down? If this goes down, that would be more positive for stocks. And then we look at a number of different ratios. This is the S&P 1500 looking at short-term bonds where we've been going up for the most part, but lately we're seeing some weakness here. Then we look at another broad market measure and go further out with bonds, 3 to 7 year bonds, coming back down into the rainbow, which is negative for now. The tech sector to 3 to 7 year bonds, we're actually dropping below the rainbow, but we've done that before and we were able to recover. So we'll see if we get some improvements with this chart. And the QQQs to 3 to 7 year bonds coming down into the rainbow. And then home construction versus 3 to 7 year bonds. This is not looking good at all. We're below the rainbow. The lines are rolling over and starting to come down. This had been a stronger area going through the end of 2023, and then we came down to the 250 period moving average here and bounced up off of that. Well, we get into October, November 2024, and this really started to see some weakness, which still continues. And then we're looking at staples, which is defensive versus the S&P 500. For the most part, this had been declining. Now we're starting to see this go back up. If this continues to go up, that's going to be a concern. And that's why we're saying the market could be developing into a more defensive posture. The technology sector coming down deep into the rainbow right now, but we haven't dropped below the rainbow yet. Semiconductors, which are a huge part of tech, with the SMH ETF here, we're dropping below the 200-day moving average. We're barely in an uptrend. The blue line's above the red line, but if we stay down here, this is going to develop into a death cross. And then here's another look at that same one where we're actually dropping below the rainbow here as we've been seeing some weakness. And then the SOX index, which also measures semiconductors, this has already been in a downtrend and going sideways at best. But now we're seeing some weakness, even though it did bounce up on Friday. And we look at a ratio between the semiconductors and the tech sector, just kind of chopping around. You go back to the latter part of 2024, it looked like, okay, maybe we're seeing some strength here, only to come right back down with this ratio. And we're not really seeing a lot of conviction at this point. And then the Dow Jones semiconductors, this has been more positive, but we're dropping below the 200-day moving average. The longer we stay down here, the more this could turn into a downtrend. And then we look at a ratio between semiconductors and the Dow. This continues to trail off and go down for the most part. So then what are some areas that I'm watching? These are just percentages where when we had that end of the world day last summer, we had just set a new all-time high in July with the S&P, and then we started tanking down here. About the time we fell 10%, because that's usually the definition of, okay, we're just pulling back. We're seeing, excuse me, some declines. But when we got close to that 10% level, the smart money came in and said, "Okay, we're gonna do some buying now." And that took us up out of that. Well, then as we got into December, we set an all-time high in on December 6th, and then we started to decline, but we only fell a little bit over 5%. And then we came up out of that. Well, then we just recently set an all-time high here, and we've been declining a little bit over 5% so far. These are more normal. These are just pullbacks to this point. This isn't really shifting over to a real bearish stance. Now, we are watching other areas, the growth versus value. But you also are seeing internals in the S&P that are holding up fairly well, like the advanced decline line, the new highs, new lows, the moving average studies that we do. If we continue to drop down here and we get close to this 10% level and buying doesn't come in at that point, that's going to turn things more negative. So right now we're just kind of watching this just to see how it unfolds, not really making any kind of a decision from this. This is just observation. We want to keep an eye on jobless claims. They really went up lately, and the moving average is going up in the latest reading here, and that could show some economic weakness. But the continuing claims are actually still declining, even though the moving average is going up slightly. So folks are getting unemployed, but they're not necessarily staying unemployed for a long period of time because this goes on the second week going out. Now, in the upcoming week, we're going to get the employment situation report on Friday, and that's going to be really telling as to what's happening with the economy. And then I just have all these things here on the same chart, the initial claims, the continuing claims, and then the latest unemployment rate. And now we're just about getting ready here to fall out of this red area. This is a variation of the VIX, and we've been up in this red area for a long time, and it looked like we're getting ready to come down only to go back up. We don't know if that's going to happen or not. We don't really know if this is positive or negative. It's just the market is still anticipating some kind of a big move, and when we're up in this red area, that move hasn't happened yet. So we're just waiting to see if we do drop down or we're going to go back up into this red area more. And we look at the react or the interplay between cash, which is 1 to 3 month T-bills, and then further out, 3 to 7 year bonds. This has been going up, and that was causing some concern. When this ratio goes up, that means there's worries about interest rates and inflation. Lately, it's been coming down, but not enough to change this to a downtrend yet. We watch that same thing here with TIPS, which do adjust for inflation, their Treasury inflation protected securities. When the market is concerned about interest rates and inflation going up, they get into TIPS and they tend to outperform. Well, that's what we've been seeing lately, but we've been getting kind of choppy here, and we came down enough to actually have a downtrend when we measure this on a trending basis. But the longer we stay above both of these lines, we might see this in an uptrend. But we're not seeing an awful lot of conviction with this chart. It's just chopping along sideways. This is a little more telling. This goes further out with tips in 7 to 10 years instead of 3 to 7 years. This had really been going up. Inflation fears, interest rates going up. Well, lately it's really been dropping back. If this can continue to fall, that might be more favorable for stocks. And we're keeping an eye on the 10-year yield in Japan. It's been going up, and this is what caused the end of the world day last summer when interest rates in Japan started to go up, and they're still going up. And we're wondering, is that going to matter at some point? And then another thing that's interesting is that we have the 10 to the 2 yield curve. When it's above this blue line here, that means we're regular. All right, that the 10-year yield is higher than the 2 year yield, which is normal. You further out you go, you should get a higher interest rate. Well, what's interesting here is we're going back to being inverted with the 10 to the 3 month yield curve. I wanted to show the 10 to the 2 because we're not inverted. We're here, we are going back to being inverted, and this is economic concern. Now, we could come down here and stay here for a long time. We went inverted back in 2022 and didn't come out of this until later in 2024. But we'll see. Is this going to last for a while? Is the 10 to the 2 year going to go inverted? Because that, when they stop being inverted again, that's when we start the countdown to say, okay, 5 months, 6 months, typically we'll go into a recession after that. Well, this is just beginning right now, and we don't know how long this is even going to last. So we're just keeping an eye on this one. We want to keep an eye on oil, which has actually been going down. This is not necessarily inflationary. We're dropping below 70. But at the same time, this has the market a little bit concerned. It's like, how come oil's going down? There's no demand for it. That's going to hurt oil companies. That's going to hurt growth prospects. So you can take a positive and negative side with this chart. And then we want to keep an eye on the dollar, which had been falling down here, but it's still in a longer term uptrend, and it was up on the week and it was up on Friday. So thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.